And you know what? $3,000 isn't a number that excites me at all. I wouldn't own as much gold as I own if I thought it was going to go from $2,700 to $3,000. I own it because several times in my life, it's gone up fivefold or sixfold or sevenfold. I own it because the net on-balance sheet and off-balance sheet obligations of the U.S. government exceed $120 trillion. And those obligations, both on and off-balance sheet, annually exceed the gross income of the federal government before expenditure. That's why I own gold. I don't own it because I hope it's going to go to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000.
RickRule emphasizes that their investment in gold is driven by concerns over the U.S. government's massive financial obligations, exceeding $120 trillion, rather than expectations of modest price increases. Gold could rise significantly, potentially reaching $9,000 or $10,000, driven by these overwhelming liabilities, rather than just a modest increase to $3,000. The speaker views gold as a hedge against the risks posed by the U.S. government's fiscal situation. The speaker, RickRule, a well-known investor and resource industry expert, recommends that individuals allocate at least 5% of their net worth to physical gold, advising that they hope for a price decline. The conditions that typically drive gold prices up are often unpleasant, but silver and gold generally move in tandem, with gold leading the way. Silver tends to outperform gold when it rises. For those considering physical commodities, gold, silver, platinum, and palladium are the most convenient to hold and store. The speaker, RickRule, highlights that during a significant gold price increase, such as a 30-fold rise, having 10% of your portfolio in gold could result in a substantial overall portfolio gain. Even during a more modest bull market like 2002-2010, where gold increased sevenfold, a small allocation to gold could protect the rest of your portfolio from the adverse effects of U.S. dollar depreciation. However, the speaker cautions against over-investing in precious metals or risky assets like penny stocks related to gold and silver. RickRule discusses the discrepancy between the physical gold and silver available for delivery and the much larger volumes traded in futures markets like COMEX and LBMA. While these markets often trade over 100 times the amount of physical metal available, the physical gold and silver used for settlement must meet good delivery standards. This creates potential issues when physical supply is strained, mainly as foreign central banks warehouse large amounts of gold. The speaker advises holding physical gold and silver in a system that ensures liquidity, mostly if short-term price movements are a factor in your investment strategy. Here are key insights from RickRule's recent interview. Before diving in, don't forget to subscribe and hit the bell icon for timely updates.
I would suggest that people have at least 5% of their net worth in physical gold. And I would suggest that they hope it goes down in price. The set of circumstances that causes your gold to go up rapidly in price, which I think we're likely to see, are invariably fairly unpleasant. But certainly if silver is cheap, gold is cheap too. Gold generally moves before silver does, although silver, when it moves, generally moves further and faster. If the question goes to holding physical commodities as opposed to holding equities around physical commodities, the most convenient to hold and store are gold, silver, and platinum and palladium. When the gold price moved 30-fold, had you had 10% of your portfolio in gold, you would have enjoyed a triple over that decade on your total portfolio. If you had gone through a much more modest bull market, like the period 2000 to 2010, where the gold price went from $250 an ounce to $1,750 or $1,800, which is to say a sevenfold increase, a fairly small proportion of your net worth in gold would shield most of the rest of your portfolio from the harmful impacts of the deterioration in the purchasing power of the U.S. dollar. Many, many, many people overinsure. Many, many, many people have too much of their assets in physical precious metals or more riskily in penny stocks associated with gold and silver. The gold and silver price is nominally, at least, as is suggested, set by the LBMA and the COMEX. It's important to note that most days, the futures market in precious metals trades over 100 times the amount of gold and silver available for physical delivery, to the extent that increasing amounts of physical gold in particular are removed from access to COMEX, you set up a circumstance where perhaps ultimately the tail stops wagging the dog. I'm not saying for sure that's going to occur, but I think it's a very interesting circumstance. And it's interesting to note, too, that when that happens, many people who suggest the inevitability of, the inability of that to become a problem, forget the fact that in order to settle COMEX or LBMA obligations, the physical gold and silver has to be good delivery, which is to say all the scrap gold and silver, all the gold and silver outside the system, all the gold and silver held by the Indian peasantry, can't automatically be used to fulfill those obligations. It needs to be often re-refined, re-assayed, and entered into good delivery. So the circumstance where the continued warehousing of gold by foreign central banks begins to disrupt the availability for good delivery in a market where 100 times the amount held for good delivery trades every day becomes an increasing challenge. I would tell people, too, that one of the reasons why you should hold your physical gold and silver in system available for good delivery is that very often if you're engaged in midnight gardening, which is to say if you hold the gold and silver yourself in your backyard and you want to take advantage of price movements, short-term price movements, you need to reintroduce that gold or silver into the system. I'm not suggesting that there aren't other reasons to have physical gold and silver in your possession as opposed to in system. But if you are using it as investment liquidity, it's important that you have some in system where it actually is liquidity.
The speaker, RickRule, emphasizes the importance of securely storing physical precious metals in vaults owned by publicly traded companies like Brinks, Loomis, or Viamat, which can be audited for financial transparency. This ensures the safety of the stored bullion. The speaker stresses the need for vaults to follow best practices and provide access to their balance sheets and income statements to avoid any risk to the stored metals. They make it clear they will not work with vaults that do not meet these standards. The speaker discusses the financial complexities of the Saudi budget, highlighting the significant social spending required to sustain the Saudi state beyond just oil production costs. While Saudi Arabia's production costs are low, they face substantial state expenses. In contrast, with higher operational costs, Exxon is not burdened by similar state obligations. Regarding Exxon XOM, the speaker notes that its short-term performance depends on factors like Middle East peace, the situation in Ukraine, and global economic conditions. However, for long-term investors, Exxon remains a solid choice due to its generous and rising dividends, with the speaker personally planning to hold the stock indefinitely. In the resource industry, particularly for non-US companies, costs are often in the local currency, while the product is sold in US dollars. For example, a Canadian gold producer sells its product in US dollars but incurs labor, energy, and materials costs in Canadian dollars. A falling Canadian dollar benefits such companies, as it reduces the cost of operations while they still receive revenue in more substantial US dollars. Now, let's get back to the interview.
The vaults will not be battle bank vaults. We will store customers' physical precious metals, whether they store the gold with us or with their dealers, and we lend against it, in vaults owned by publicly traded companies so that we can audit their balance sheet and their income statement to make sure that the vaults offer secure delivery. At present, those vaults would be Brinks, Loomis, or Viamat. There are doubtless other vaults in the world that are worth doing business with, but out of an abundance of caution, if I can't see the vaulting company's balance sheet and income statement, and if I'm not assured that they don't follow best practice audit for their inventory, I have no interest in risking your bullion or my collateral. Well, the Saudi budget includes an awful lot of diversion for social spending. You need to understand that. You're not talking about the Saudi Aramco budget. You're talking about the oil price that is required to sustain the Saudi state on top of production. The Saudis' discovery cost and lifting cost is very low compared to Exxon's discovery and lifting cost. But Exxon isn't similarly burdened by that very large state, although it would be interesting to hear what role they play ultimately in funding the U.S. budget. I suspect that at the current cost of capital, that Exxon's real operational cost in the Permian Basin is less than that. The $60 number, I suspect, correctly layers in the cost of capital and the allocable share of Exxon's overhead, which goes to the Permian Basin. But I suspect that the true operational cost in the Permian Basin, before general and administrative and before cost of capital, is substantially lower than $60.
Still on the topic of Exxon, Cajun Jameis 9001 asks, XOM, will it come back up?
Of course. Function of time. A few things get in the way of Exxon in the near term. One would be improved prospects for peace in the Middle East. I think there is a bit of political risk premium built into oil. The second would be peace in the Ukraine. Both of those are bigger than me. I'm a credit analyst, not a political analyst. The third would be the threat of recession and depression. A global economic slowdown means that you can have supply shortages if you have a demand shortage, and the price doesn't have to move. If one is prepared, as I am, to hold Exxon for the rest of one's life, I'm 71 years of age for the record, almost 72, then you don't worry too much about near-term perturbations in price. Note, too, that some of the pain of holding the stock is taken out because of its generous and rising dividend, particularly non-U.S. domiciled industry, is that their costs are often denominated in their home currency, while the selling price of their product is in U.S. dollars. So as an example, if you're a gold producer in Canada, you sell your product for U.S. dollars, but your costs, your energy, your labor, your cement, your steel, are priced in Canadian dollars. A falling Canadian dollar is a benefit to a company that sells its product in U.S. currency while paying for its costs in their domestic currency.
The speaker emphasizes the importance of gold as a hedge against the U.S. government's fiscal challenges, recommending that individuals allocate a portion of their wealth to physical gold while cautioning against overexposure to precious metals and risky assets. They highlight the complexities of the resource industry, the need for secure storage of precious metals, and the factors influencing investments like Exxon, particularly geopolitical risks and market conditions. The speaker stresses long-term investment strategies and careful consideration of physical assets and market dynamics. How does the speaker view the relationship between the U.S. government's fiscal obligations and the potential for gold price increases? Why does the speaker recommend holding physical precious metals in vaults with publicly traded companies, and what are the key factors to consider? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.